So, Matt, I am really excited to talk about a really amazing year. And I think that we all can describe what we think amazing means, but 2026 was a phenomenal year in some ways. I think for many of us, maybe caused some heartburn and some, some potential anxiety just because there's been so much going on. And so excited to talk about that. And, quite frankly, even more importantly, talking about the year ahead, 2026, which I'm going to just tell you, 26 was one of my numbers that I wore in basketball in high school. And so I'm just thinking it's going to be a really good year. Now, I'll let you be the one to kind of elaborate on that, but really excited to chat with you today.
Well, you as well, Stacy, and I'm excited to learn about the number. I didn't even factor that into my out or forecast for 26, but we should see, I would assume,
Yeah,
even
I mean,
stronger results.
yeah, and all of you listening, so we have a fantastic like pros and cons slide for each of the different policy changes, and I imagine that we can get my baseball or my basketball jersey in there somewhere with a pro. So there we go, there we go. But Matt, let's get started. I know we have a lot to go through, um, and what my hope today is that we're going to talk about, 2026, talk a little bit about the outlook as well. We're going to talk about pros and cons, impacts of tariffs, impacts of other different policies. And, my hope for everyone listening is that you have a cup of tea or you have a coffee or whatever your favorite drink is, and that you find this really interesting. And in particular, our goal, even though we're going to be talking about some pretty sophisticated things, that you walk away feeling more empowered, you feel smarter, and have more peace of mind about the market and also your portfolio. So let's get started. I mean, here we are. We're talking about 2025 with the tale of two parts. Can you talk to me a little bit about what that means, the tale of two parts?
Sure. No, as I was looking at 2025 and reflecting back on what had happened in the markets, I wanted to do a tale of two halves, but it wasn't quite a half. And so you may remember, Stacy, that in early April we had the Liberation Day tariff announcements.
Yep,
And that drove a pretty strong sell-off. We'll show you a picture of that here in a minute, but a pretty strong sell-off in the markets. A lot of concern amongst clients, a lot of concern among investors in general about what direction we were heading. And then late in April, the markets took a sharp turn, and that's the second part of the story. And we
got it.
got into some Trump stepping away from some of the tariffs that he proposed, and we saw a really sharp recovery as well. And so I'll give away the punchline before we even get started. It ended up being a spectacular year for the markets, but there were really two separate parts, and that's the two parts we want to talk about here as we move forward.
Great. And then we'll also be talking about 2026. And, so much of 2025 reminds me of 2020. It was about the same time frame, March and April in 2020, that the markets took absolute nosedive. And then very quickly recovered, and we had one of the strongest years in 2020 during the absolute depths of COVID. I think surprising a lot of people. And so, not everything's the same, but I do feel like there definitely is uh, a point to be taken that, large downward, spirals does not mean that it's going to stay there. And that, at the end of the year, you can look back and many of those years are very positive.
Yeah, absolutely. And that's one of our key takeaways. I think our wrap-up slide, we'll try to highlight some of those things and how
Yeah.
staying invested is just so important.
It is, it is. And so let's jump in. So the markets Liberation Day. So tell me a little bit about Liberation Day. I know a lot of experts call it as, say it was Wednesday, April 2nd. Um, t that was the rolling out of the new tariff plan. Is that right?
That's exactly right. And so, Trump named that Liberation Day. He's definitely one for catchy names as he goes
He
through.
loves those catchy names. Yep.
Yes.
Public
And
relations, PR, all over,
yeah,
all over it.
absolutely. And so what happened that day is Trump surprised the entire investment community. I was actually at an investing conference in Phoenix, talking about some real estate investment options. It was interesting to sort of watch as those announcements came out that morning and they were trying to get people's attention to start the conference. There were a lot of people out in the hallways talking with clients and looking at
Yeah.
their phones and everything else, trying to figure out just what was happening because it was such a surprise with the magnitude of the tariffs. We knew the tariffs were coming. He'd announced the Liberation Day, but it was the magnitude that really took the markets by surprise.
Yeah, and actually, this next slide I think is really interesting. It looks at the beginning of the year, January 2025, all the way through to, towards the end of April. And right in there, I mean, we can really see, come after that announcement, a real quick drop. And so that is a question. Why did the markets, really react so significantly to the tariff announcements?
I think the big thing really was just the surprise factor, how significant these tariffs were. Everybody looked, all of us, when we're looking backward, we try to look at what happened during the first Trump term and what did he do with tariffs. And he used them as a negotiating position then, but they were all, at least by these standards, relatively moderate tariffs.
Hmm.
Some of the
Hmm.
numbers, and we've got a slide coming up here in a bit where we'll look at a few of those, but some of these numbers were, 90% type numbers.
Yeah,
And nobody in the markets was forecasting that or expecting that. And, the big joke was there was even an island there with the penguins you see on the right where he was actually tariffing the penguins as well because there were no people actually living on that island. And so I think what happened, Stacy, was people were surprised by the magnitude and
yeah,
also maybe the lack of planning and sort of thought that went into this. And as we talked about how he came up with the tariff rates and all of that, it really did take the markets by surprise. And one thing markets don't like is surprises.
they do not. Yeah, no, no surprise parties for the market. And, I think for a lot of people, um, it and the market as well, it created a lot of concern of what does this mean on, for the everyday consumer when they go out to the grocery store or buy a car or buy a computer. What does that look like? What does it look like for supply chains around the world? What does it look like for our, international political relations globally? All those things. Are those some of the things that were, is there any other pieces that, of this created a lot of concern?
No, I think you just hit the big ones there. I hadn't mentioned that, but we tariffed our allies as well as our
Yeah,
non-allies out there. And I think that was the other part that really did surprise people is, how significant some of those tariffs were even on our allies. And I think you brought up a really important point that even is playing out, in the markets today, which is how we're viewed around the world and sort of that political stability that the US has historically been seeing is bringing to the global marketplace.
yeah, no, I know the story isn't finished. We all have heard about the ongoing tensions with European allies with regards to Greenland and the negotiations, and Trump announcing that as of February 1st, there's going to be a 10% tariff on our European imports, potentially going up to 25% by June 1st. So it's definitely clear that the story is not over. Is that right?
That's exactly right. Yeah. And that, those numbers, at least as people understand them today, and you're never 100% sure with Trump, is in addition to the existing tariffs that, were negotiated down from some of the rates you're seeing here on the screen, but are still certainly higher at the highest levels we've seen, really even going back to the Great Depression.
Yeah. And I'm just this next slide I think is really interesting. It really brings um, into into light over that 5-day period or so, how violent the market reacted here. And if you take a look, it wasn't just the stock market that we're looking here, and this is the S&P 500 taking a real tumble. I think that's about 11% drop
Yeah.
over a few days. But what was interesting is that it wasn't just the US stock market, that there was an impact also on long-term bonds. Can you tell me a little bit about what happened there?
Yeah. So what you see here in the scale, as you mentioned on the stocks, we saw a drop over 10%. And just for those listening, that's typically defined as a market correction. And that was a very, very quick correction, basically over a week there. But then on the bond side, the scale's a little bit different, but still pretty extreme. When you see we had a low point there of about a 4% on the 10-year Treasury bond, spiking up close to 4.5%. That's a very significant movement in the bond markets. And it comes back to a lot of what you were talking about, Stacy, in terms of just uncertainty, in terms of the overall
Hmm.
environment. You know, the Treasury has always been seen as a safe haven, sort of that flight to quality during times of stress. In this case, investors were sort of fleeing the US a little bit, at least in the Treasury markets, because they didn't no longer saw them as being quite as safe, didn't understand what Trump was doing again, that tariffing even on the ally side as well, really took the markets by surprise.
And when you say rates spiked, can you tell me what you mean by bond rates, just for the typical person, listening to this today?
Yeah, so yeah, when the Treasury goes out to borrow, they're generally seen as a completely risk-free loan because
Hmm.
the United States has, of course, the full faith and credit of the United States is backing that loan, and they have the ability to tax or, frankly, to print money if they need to at some
Hmm.
point in order to pay that off. So it's always been seen as risk-free, and so that's why they're followed so closely. And so when we say rates spiked, all the time, a 10-year Treasury bond that's trading all the time, every single day. It's a very, very liquid market out there. And those rates on the people were willing to lend the US government money for 4%. If we look there on that 4-4 date that you're seeing kind of the low point. And just a few days later, as we moved out a week later on the 11th, people were, if they were going to lend the US government money for the next 10 years, they wanted about 4.5%. And so that cost of borrowing went up pretty substantially for the US over that time period due to all of the uncertainty around these tariffs, concerns about the markets, and what signaling was being sent.
And so, understandably, someone who is essentially loaning money to the US government, that's really what a treasury is,
Yeah.
say, hey, you can pay me 4%. I trust you. There's no risk associated with this. But because of the tariffs, because of this concern, individuals saying, oh, wait. No, 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 no. You need to pay me more than that. Instead of 4%, I'm looking at I deserve because I see more risk. You need to pay me about 4.5%.
Yeah. And one
And
of the
and
big
so
things, oh, sorry, Stacy.
yeah, and so what does that mean though for your like average investor? So someone that is holding bonds,
Mhm.
how does that impact their portfolio?
Yeah, so the way that that impacts your portfolio is if you have bonds in your portfolio, most bonds have fixed coupon rates, fixed rates of
Hmm.
interest. So let's say you had a loan that you had outstanding to Procter and Gamble. You bought a Procter and Gamble bond, and that coupon rate, the interest rate on that bond was 5%. Well, now
Hmm.
all of the sudden, as those rates moved up, that meant that your bond looked less attractive relative to these risk-free treasuries. Before, you were getting a 1% premium for lending to Procter and Gamble because they were considered more risky than the US government.
Got it.
That premium is now only a 0.5%. So what's going to happen is if you want to sell your Procter and Gamble bond to somebody else, they're going to demand a higher rate from that bond. So they're going to drive the price down. So bond investors saw a little bit of price drop in some of the bonds they held during this time period as well. And part of that, just to go back to why this happened, I should have mentioned, Stacy, is this idea of inflation that you talked about with the tariffs. Investors said tariffs are probably going to drive some inflation. Now, we didn't see quite as much inflation as most people were forecasting as the year played out. But with that concern about higher inflation, if you think about it from a bond perspective, you're lending the US government, Procter and Gamble money. You want to make sure you're protecting the purchasing power of that. And if inflation comes in higher because tariffs are higher, that makes that 5% Procter and Gamble coupon worth less on a
Hmm.
real basis.
Yeah. So essentially, I mean, here we were in a situation where the value of people's stocks in their portfolio went down, but actually their bonds as well. Kind of a perfect storm. But the good news is, right? The good news is that wasn't the whole story, right? And let's talk a little bit about, you know, what policy uncertainty means, what that is, and then we'll go into then after that the post liberation day. So, essentially the rest of 2025.
Yeah. And so as you think about policy uncertainty, as I mentioned before, investors hate surprises. So as we were anticipating getting ready for a Trump version 2 here, we looked a lot at what happened in his first term, and we had, expectation as to what we thought would happen. We thought they would extend the tax cuts, which ultimately didn't end up getting extended. Big focus on deregulation, particularly, within the energy development area. And we've seen a lot of that. He's done a huge amount by executive order in his first, basically we're at the 1 year mark here now of this term. And we thought he would continue with more of that modest approach to tariffs, using them as a bargaining chip, trying to,
Hmm.
get on that America First agenda of saying we want to have more fair trade and we want to have you take, countries outside of the US taking more ownership of defense and some of those sorts of things. We didn't anticipate the sheer magnitude of what those tariffs would be, though.
Got it. And that actually sets us up perfectly, like setting the stage for, post Liberation Day. So, here we are, the second act, and tell me a little bit about what happened in, the second part of 2025.
Yeah, so we sort of got through that April time period, and what Trump did, he definitely saw how the markets reacted. He saw a negative reaction in the bond markets, negative reaction in the stock markets, and he started to walk back. Immediate portion was he delayed the implementation of the tariffs, and then
Hmm.
started to announce, some agreements that came out there. And it became, I don't know that Trump necessarily liked this, but everybody in the investment world started talking about the taco trade. Trump always chickens out, and so the tariffs kept getting scaled back and scaled back as they went, and realizing that the tariffs really weren't winning for him necessarily. He
Hmm.
shifted his focus more to getting the one big beautiful bill passed. And again, we talked about his enjoyment of fancy marketing titles. He,
Hmm.
he worked on working with that, and that did extend those tax cuts. So that tax
Yeah.
cuts that we largely ignored through April, he made a strong push there through the summer to make sure that that happened, and that those were seen as a large and significant positive to the equity markets in particular.
Hmm. Yeah, no, a lot of tax cuts, and for many people, their tax bills going down in 2025, and potentially also going forward. Tell me a little bit about also the AI movement. Like we all hear about Gemini and Claude and Jet. I always GPT, GTP. It I
I can't
tell
say it right now because you just
I
said
know, I know, because I just butchered it. But um, did that have an the influence on 2025 and the markets as well?
Yeah, absolutely. I mean, that was the great thing about the economy as we were moving in. We actually had a very strong economy coming into 2025. And
Hmm.
this was a self-inflicted wound with the tariff magnitude that was put in place there. And so as we started to step back from that, extend the tax cuts so businesses knew they had certainty about expensing of capital improvements and all of those things, and then allowed, the US continues to be an incredible leader in the AI space. Companies like
Yeah.
NVIDIA, growing just rapidly. They've got the next 2 years of production that they can produce are actually already pre-sold to various companies out there. And so these big tech firms, the Googles you mentioned, the Microsoft, the NVIDIA, all of these firms are really printing huge amounts of money, but they were
Hmm.
also making huge investments in capital expenditures. And so they were driving a lot of growth as well. We saw huge growth among the utility sector in 2025. Normally, you wouldn't expect that in a really hot stock market like we had,
Yeah. Yeah.
but all of these companies, because of the huge power use for AI, these utility companies have seen strong returns as well because they're going to have to, they can charge higher rates. They're going to have to
Yeah.
continue to grow and expand, which will drive additional manufacturing here as we're looking to produce power plants. all of those things really drove strong growth from an overall economy perspective in the second half of the year once we got past that sort of self-inflicted wound in the first half.
And that last that last bullet, the EPS, earnings per share, um, really strong corporate profitability, which is just a fancy way of US companies doing really well
Yeah,
and showing and posting really, really good profits
yeah.
overall.
Yeah, absolutely. You see 12 to 14% growth will steal a little bit of our thunder from the
Yeah,
2026 outlook, but we're forecasting probably 15% growth in 2026 as well. So
that's
companies
amazing.
did exceptionally well over the last year.
All right, so I am going to show what everybody has been looking forward to. We can do a little drum roll, and this is what actually happened last year. I love this slide, and let me just take everyone through it because I know there's a lot going on. Um, we went through and created this beautiful slide, and it shows all different parts of the market, or what we could call asset classes. And we showed you how did they perform in December 2025? How did they perform throughout all of 2025? What is the actual return? And then what was the return for that asset class if you were to look on average over the last 5 years? And so you have light green in December, um, a nice gray slate for 1 year, and then actually my favorite color, that beautiful, bright, vibrant teal for the 5 year annualized, which I mean, I'm sure you guys didn't pick it, but I love that you use that color for the 5 year analyze because the goal is to stay invested, right? To stay invested, in the ups and the downs. But as you look at this chart, where were the winners of 2025? Which of those asset classes were the winners? And what were the others in 2025 who maybe, didn't do quite as well?
Well, really, as I looked at the chart, I'd say we were all winners in 2025. That was what I think was the most
Yeah.
interesting
I
thing
was
about
looking, I
it.
was like, who was a loser? I was like, this is like, a win-win, right?
Absolutely. What was obviously the outlier here for 2025 was the really strong recovery in international markets. You see the 32% there on the far right. But if you looked across US stocks, you had 17 to 20% for large, big growth companies in the US. And even bonds, the bonds that everybody started to hate after 2022, they provided an exceptional year last year with returns
Yeah,
positive over 7%, along with providing consistent income throughout the year. But for me, probably the number I pay attention to the most because it's the most relevant to our clients who have diversified portfolios. We have a lot of clients who have that traditional, what people call a balanced model portfolio, about 60% in stocks and about 40% in bonds. And they had a just under 14% year last year. But more
that's
importantly, to
amazing.
your point, which I think is the most relevant one for us as long-term investors, look at how that's compounded over the last 5 years for our sort of our typical client, if you will, has seen their portfolio grow at about 8.5% compounded rate over the last 5 years. That's
That's
including in there.
phenomenal.
Well, think
Yeah,
about what's included in there, Stacy. You talked earlier about 2020 with the
yeah,
pandemic,
yeah,
significant bear market in early 2020. 2022 was the worst year for a balanced portfolio going back to the Great Depression because bond rates moved up so much with the high
yeah,
inflation.
yeah,
And that's still compounded for those investors who worked with us and said, we're going to close our eyes, endure the short-term pain. You compounded at 8.5% a year.
yeah. No, I think it's so powerful to see that. And I 100% agree that it's interesting to look at all the different asset classes, but really what's most important is your portfolio. And we build portfolios to have kind of like cushioning. We call it the cushioning, or what I call the airbag in a car, bonds, and then also the engine. And the engine we look at more as like stocks, international and domestic. And I think what's really interesting here, it made me really it made me really happy for, I don't know if the right word is underdog, but international stocks and emerging market stocks I feel like they haven't gotten the respect that they deserve over the last couple years. They always have been trailing US stocks. And look at this, a 32% return for the year in international stocks. And I mean, US stocks did well too, almost 18%. But, they nearly doubled that. Okay, Matt, tell me about how this happened. How this happened, and actually emerging market stocks doing phenomenally well themselves too.
Yeah. Yeah, no, a couple things happened that really helped. And I think, first and foremost is why it's so important to have a diversified portfolio. I look at everybody's outlook from the street, and I always save them so that I can go back at the end of the year and see what did they tell us was going to happen and
Yep,
what really
yep. What
happened.
actually happened?
There were not a lot of people out there at the end of 2024 saying you should shift into international stocks because they're going to have a spectacular year. So really highlights the importance of why we stay diversified, why we're not trying to time the market because they just move incredibly fast. But there
Yeah.
were a couple things that happened that really drove this. One was the weakening of the dollar. So
Mm,
with Trump really pushing for a weaker dollar. That's part of his policy agenda is to have a weaker dollar. Inflation remaining a little bit elevated here in the US. That drove down the value of the dollar. So somewhere between probably 8 and 10% of that return came simply from that weaker dollar as we took returns in foreign countries and brought those back to our US investors.
okay, so
So,
let me just stop you there. So,
okay.
um, you know, just to translate that. So, if we're owning a ETF or a mutual fund of foreign companies, they, essentially are trading in their own currency, right? Let's say the pound. And if the pound is here, and let's say the US dollar is here now, they have never been on par really, but let's just say that the US dollar comes down, the pound is worth more. That pound is going to buy more dollars, right? Because
Exactly.
it's stronger. And actually, I think about the opposite. When I was in Oh my gosh. In college, junior year, lived in France, and every dollar could buy so many francs. It was amazing. I felt like I was rich. And we went and visited there a couple years ago, and it was the exact opposite. The US dollar couldn't buy nearly as many francs. So the challenge is for those of us traveling abroad, our dollars are probably not going to buy as many pounds or actually now it's euros, right? Because um, that tells you how long ago I went to France when they had francs and not euros. Um, but it's interesting because the change in the US dollar value can have a really big impact on your returns from international. And it's definitely this year with the headwind was or the tailwind was in the right direction as
Yeah.
well.
Yeah, that was a nice portion of the return, but again, certainly not all the return. And
Yeah,
the other
yeah.
part came from some pretty significant stimulus investments that a number of companies, most notably Germany, made
Hmm.
that started to drive. They also started to look where, one of the ideas I think of this make or America First agenda from the US and the Trump administration is other countries are realizing they have to focus on themselves as well. They can't necessarily rely on us as much. And we can talk about from a policy perspective whether that's good or bad, but from an
Yeah.
investment perspective, they started to make more investments in defense. So a number of the
Hmm.
defense
Hmm.
companies did well. A number of the financial companies did well. They
Yeah.
through some additional deregulation in some of these markets. So these other countries really focusing on their markets had a big impact. And then, of course, it's the rising tide of the overall global economy.
Yep.
Despite all the tariff ups and downs and other things, the global economy had a good year, which contributes to a lot of this as well.
So the next slide is okay, other than this one, the next slide is my second favorite. And the reason this is my favorite, other than, it's very interesting to look at with all the different colors. It goes all the way back to 2006, and it lists an order and ranking of highest return from the top of the page all the way to the bottom, all these different asset class, the ones that we just spoke about. And I'd love to focus on 2025 and the differences that we saw. In particular, 2025, the top two performing asset classes were emerging markets and developed international. And if you go back over the last couple of years, those two, in some years have done okay, but a lot of times they're kind of towards the bottom, similar to what we had said. We also saw last year doing really, really well following those two large companies, and then also some small companies as well. So really interesting. And the other reason I like this is I don't know about you, I've looked at this chart so many times in so many different ways, but I have not found any correlation between a, an asset class being a top performer and how it behaves the next year. In fact, 2017, you can see that emerging market stocks were the number one place you wanted to be. But look at that. 2018, like one of the worst performers. So this, I feel like, really supports that that conversation that we have of timing the market and trying to get in, when the market is going up, um, doesn't always, in fact, I'm just going to say it, never serves you well. Can you talk a little bit about that?
Yeah, I think you're exactly right, Stacy. And that's what I love about this chart is it there is no pattern. You can look
Yeah,
at it, you can
thank you for saying that because
sit there
I
all
keep
night
on trying to like,
staring until your eyes bug out trying to see the pattern there, and there's not. And that's why that diversification is so important. We talk about it as the one free lunch in investing. We properly diversify the portfolios and it smooths the ups and downs over time. And that's why
yeah,
it's so important. Again, as I said a little bit ago, there were very few people, very few of these big investment banks spending millions and millions of dollars on research who were saying at the end of 24, you better jump all in on emerging market equities because they're going to dominate next year. Because nobody knows. You can't time the
yeah,
market. And
no.
that's why when our client portfolios, you have really, exposure to almost all of the different colors you see on this screen.
Yeah, and I also really hope that this conversation and looking at this table helps everyone listening today that, if you're going through the, you know, TV changer and you're going, I know I do this. I'll be watching something, they go to an ad, so I look for something else that doesn't have an ad. And then sometimes you come across anything. Well, some of the things that you might come across is, you got to invest in this year and it's going to do really well. Especially we tend to see that in the spring of each year of like where you need to put all your money. The good news is that you can actually just not waste your time and keep on clicking and go for something else. Like maybe, I don't know, I've been watching The Great British Bake Off. That's worth a huge amount of your time. You'll become a better baker. Lego Masters is another favorite of mine. But needless to say, spending that time and, going to a lot of the pundits out there saying exactly where to put your money because that's going to be the for sure deal for 2026. Well, they're most likely wrong. Most likely wrong. Yeah. Well, actually,
Absolutely.
that's
I would
perfect.
throw in that the
Yeah, go ahead.
NFL as well as the college football playoffs have been very good lately as well. So,
There you go. There you go. That's another one. See, there's so many different options out there.
yeah.
All right, so
Anything
let's
to
look at,
avoid the CNBCs of the world, right?
I know, and I love CNBC. I'm on their financial advisory council, so I do a
Yes.
lot of work with them writing articles and going on TV, and their work is really important. But sometimes, depending on which pundit they have on there, sometimes they can be a little bit like, I don't know. But all right, so here we are, 2026, and love to talk a little bit more. I mean, we know it's lucky already because, I wore that number with my basketball jersey. But let's go ahead and actually talk a little bit about what you got from U.S. stocks. So, what are the pros that are really offering a tailwind to support U.S. stocks potentially doing well in 2026?
Yeah, so a lot of really good stuff as we sit here and take a look at what's coming up in the market. You've got productivity growth has been very strong. AI is really, I think, helping on that front. We've seen some incredible numbers. So what's been impressive on the productivity side is with the current immigration policies, we've had a lot fewer workers. At the same time, companies have been able to generate really strong profitabilities we already talked about, and that comes through productivity. So that's been a huge uplift. Somewhat less trade war uncertainty as we're working through. Oil
Mhm.
prices are down. That was one of the big negative or well positive announcements, but negative numbers in the most
Mhm.
recent CPI report was to see that oil prices were down. If you look at the one big beautiful bill, there are some definite benefits as we look
Mhm.
across the economy there in terms of not having tax on tips. We're not going to have some tax on overtime for certain people as well. And then, as we talked about before, that expensing for companies to be able to expense some of the capex right away is a big uplift for them on profitability. We talked about the AI spending, expected to get pretty significant tax refunds this year, well above averages. So that should be some good early stimulus
Yeah,
because of
yeah.
those cuts. And then unemployment continues to be very low. We haven't seen a lot of growth in the labor market, but we haven't seen a lot of firing either. And so unemployment's at really low levels.
All right, so let's go on the other side. What are the potential headwinds or things that um, could work potentially against U.S. stocks this year?
Yeah, so big one for me. I'm a little bit of a contrarian by nature. I never like to see things that have done so well for so long. We've had
Mm,
3 really good years in the US stock market, and prices are expensive. Stocks aren't as cheap as they once were, and so we definitely need to watch that. I mentioned before that we think the forecast by the analysts are for about 15% profit growth for this year after a 12 to 14% number in last year. That's a high hurdle to meet.
that's a big, I call them big, hairy, audacious goal. But I mean, those are the forecasts, right?
Yeah, those
Wow.
are the forecasts, which means disappointments could happen.
Mm,
If we have
hmm.
a 12% number, that's still a great number this year,
Yeah.
but it's a disappointment as it comes through. There is ongoing policy uncertainty. When I put this together, Trump had talked about capping some credit card rates, buying back some mortgage bonds to try to drive down mortgage rates. You mentioned already, Stacy, the big headline of the weekend, of course, which was Greenland. Definitely with this administration, you're going to have ongoing policy uncertainty. And so we
Yeah.
don't know
Yeah.
what's going to come out there. I mentioned unemployment is low, but job growth has been slowing and inflation continues to be a little bit sticky there. And then a big wild card, we're waiting to hear from the Supreme Court is were the tariffs legal in the way that Trump did them? And so do we need to issue tariff refunds potentially to impacted parties? And what does
Yeah.
that mean? And so definitely some things there to balance that, which is why you see, kind of in the top right there, we somewhat neutral on U.S. equity. We think there's reasons it could do well, some reasons it may not. And so we're trying to really maintain that neutral weight with client portfolios.
So a little bit of caution at the same time with a lot of wonderful opportunities too. So let's talk about U.S. stocks. You had spoken about valuations being high. And so this chart talks a little bit about that. Can you talk about what do you mean by valuations high and
Mhm.
how they might relate to this chart, which is we call price to earnings ratio?
Yeah, so what we're thinking about here is when you invest in a company, you're buying a portion of their future earnings.
Hmm.
And the
Hmm.
question is, how much do you have to pay for that dollar of earnings? So in this case, what we're seeing there on the far right, you see that 22 number. That means investors are paying $22 for a dollar of earnings. So a logical question might be, why am I paying more than a dollar for a dollar of earnings? Well, because the company's not just going to earn this year, they're going to earn next year and the year after
Yep.
that, and so on and so forth. And hopefully those earnings are going to go up. We talked about that 15% earnings growth. But what you can see is if you look back over the last 30 years, we've paid about $17 for a dollar of earnings. This year, right now, we're paying about $22. So that's what I mean in terms of it's expensive. If we want to
Yeah,
buy the
got it.
companies now, we have to pay more.
It's like the price of eggs.
Exactly.
It's like the price of eggs. And so I understand. I mean, that is a concern because, yeah, they're higher valuations. Can you talk to me about, the portion of the indices out there that are being, that have significant exposure to AI? And just so you know, indices, it's a fancy way of saying like a basket of stocks. And so the S&P 500, that is a basket of the 500 largest stocks that trade on the stock exchange. And so can you talk to us about that? And also, also what the MSCI world is, because that's a little different. Most people understand the S&P 500, but the MSCI world indice, I actually feel like is um, a better basket of stocks that represent both what's going on here in the US, but then also abroad.
Yeah, yeah. And so I think, on the index question, we'll sort of take the second part first and then go back. I agree with you on that, and that the MSCI world is designed to pick up those stocks all around the world. So
Yeah.
emerging markets, developed markets, US markets, all of those are included versus the S&P is, as you said, just 500 really big US companies.
Hmm.
And so if you want to truly see what the global marketplace looks like, I think the MSCI world does a much better job of that. And what you can see here, and the reason for this chart, sort of talking about this idea of a lot of exposure to that AI movement. And you can see
Mm.
that within the US and the S&P 500 in particular, those top names, and we've been talking for years now about the Magnificent Seven, they make up all, these AI related names make up almost 30% of the S&P 500, meaning if there was a downturn in AI for some reason, that could have a pretty big
Yeah.
impact on the overall economy there. And so that's one of the things, for us as we're looking at the markets this year. We think this may be a great year within the US to broaden out beyond those Magnificent Seven, using some
Hmm.
smaller, some mid-cap companies, some value companies that are really going to be the beneficiaries of the increased efficiency, that productivity we were talking about that comes from implementing AI. So last year, year before, the companies that developed AI, they're the ones that saw the real gains there from a market perspective. But what we started to see post October of last year was a shift to kind of that the other 493 in the S&P 500, or if you look at the MSCI world, a lot of the small, the mid-sized companies out there as we go around the world.
And tell me a little bit more about those Magnificent Seven. So I'm going to try, you tell me if I remember them. So Amazon, Google, Facebook slash Meta, um, Netflix, what,
Microsoft,
Microsoft. Okay, now there's two more. I'm not going to get them. NVIDIA?
NVIDIA, yeah.
Yep.
And
And who else?
well, now you've got me thinking I'm missing
Okay, now
one.
let me look it up. All right, this is like live for everyone. Um, Tesla. Tesla's
Tesla,
the
there
other
we go.
one. There we go.
Thank you.
Tesla's the other one. So yes, definitely diversifying outside of them and making sure that we have, real exposure. What's interesting too is that when we look at the MSCI World Indice, we can also see that, there's less exposure. There's much more diversified exposure just within that index as well.
Yeah.
So
And so, we see that as an uplift. We'll talk about international stocks in a minute, but we see that as a
yeah.
potential uplift for international stocks.
Yeah, no, that's great. Actually, here we go. Here we go. International. So talk to me about the positives of investing in international stocks for 2026.
Yeah, so we just talked about expensive within the US market.
Hmm.
Well, even after a strong year last year, international stocks are still very attractively priced. We're paying less for each dollar of earnings than we would have to for US stocks. So we have
Yeah,
more affordable
essentially
companies.
cheap. Yeah, and and just so you all know, Matt and I love cheap. We do not like paying high fees for things. We're very smart. We're very smart about where we save money, but definitely the valuation. Oh, there we go. I got too, you see, I got too excited about this. I got too excited and I moved the slides. So definitely less expensive for every dollar of earnings. And so talk to me about the ongoing weakness in the dollar. Number one, do we see that the dollar will continue to stay a little bit more weak against other currencies abroad?
That is our expectation. As I mentioned, Trump has made it very clear that he wants a weaker dollar. He sees that as a competitive advantage, good for US companies to export, those sorts of things. So he would like to see a weaker dollar. As you also know, he's going to name a replacement for Powell as the Fed Reserve Chair.
Yep.
And that person is most likely going to be someone who's consistent with him from a view perspective that rates
Yeah.
should be lower. And if rates are lower, the concern there is inflation stays at higher levels, and that's also a negative for the dollar as well. So I think there are a couple things there that could drive some
Yeah.
additional dollar weakness, where that's at least a tailwind. If we go back pre last year, the dollar had been strengthening quite a bit, and that was giving us a headwind for international stocks. Even if it's just neutral for us as we go into 2026, that should be, a general positive for us on the international
Yeah.
side.
Now, talk to me about economic stimulus and reform. You had kind of touched about that, particularly in Germany and some of the others of, really trying to kickstart their own economies
Yeah.
abroad.
And I think that that's just expected to continue as we move into 2026. And certainly, again, we can talk about the policy decisions around Greenland, but Trump is making it very clear that those countries need to operate independently from the US. And so they're
Hmm.
going to have to make those reforms. They're going to have to push those through their markets. And I think that's going to, continue to be, again, a nice tailwind of additional spending, is whether it's for defense with concerns about whether the US will step in relative to NATO and other things, but even to generate other
Hmm.
parts of their economy as well.
And momentum of having a good year and kind of having that move to the next year. Okay, so let's talk about some of the cons. There's not too many, not too many.
Yeah,
But
yeah.
obviously tariffs, U.S. policy uncertainty, and heightened geopolitical tensions. I mean, I know for me, I get my news via Apple News, and I train it to essentially show me what news it is. And so there's always typically a link to a funny cat video or a funny dog video, and then it's like hardcore news. And I'll be honest, I pick up my phone and it's almost like I'm going like this to see like what's going on today. And it sounds like, again, just those heightened geopolitical tensions and general policy uncertainty are two of three, including tariffs, some headwinds that international stocks might face.
Yeah, I think exactly right. That's always going to be out there, particularly with what's going on around Greenland, as you've talked about, and whatever the next item is. You had Venezuela here a couple of weeks ago, but yeah, if you really focus on our takeaway, or we're reasonably bullish on international stocks, we do think there's good macro conditions. Long-term growth is starting to pick up. That dollar weakness will be a tailwind for us, and we think emerging markets in particular provide some attractive investment opportunities just from strong demographics as well.
Yeah.
And so we're reasonably positive again on the international side.
Love it. Love it. And so this is just another breakdown into international stocks. And tell me a little bit about this chart and what the message everyone listening today should take away.
Well, I think the key takeaway, what I wanted to reassure people, again, being that contrarian by nature and saying, well, international had a great year last year. Does that mean it's going to not have such a great year this year? If you look back at our heat map chart, where we said, well,
Hmm.
sometimes it's here and then it's there and those sorts of things. But the great year was supported by growth in earnings. And that's the fundamentals over the long term. As long-term investors, we want to see returns come from growth in earnings. You can have short-term periods where growth comes from speculation and other things. But what really gave me comfort as we were looking at this forecast for 2026 is you can see how closely those earnings tracked to the growth in the index itself, the returns that we were
Yeah.
generating. And
Yeah, no,
so
you can see the expected return for the index of the stocks, and then you can actually see very closely aligned very nicely with the expected earnings per share, which is fantastic. All right, so we have a couple more charts. I know we're coming up to the end, but this is another really interesting chart, and it goes back to the dollar and the impact of the strength of the dollar on different currencies, how it has impacted some of these asset classes. Can you tell us a little bit more about this one?
Well, I mean, the key takeaway is, as we are running low on time, is just the fact that when the dollar is weak, you look on the left there, developed and emerging markets do really, really well from a stock perspective. And so again, supports that idea of that being a tailwind for us as we move into 2026.
Exactly, exactly. Love it. All right, now let's talk about bonds. What are the pros that the essentially tailwinds for bonds this year?
One is we're starting from some pretty attractive yields, at least by recent standards, sort of, let's say, post-pandemic standards, if you will. The yields look very, very attractive there. That gives us some cushion. Even if interest rates move up, as we were talking about earlier today, prices don't move down as much when we're starting from a higher base. So they're giving us that downside protection. They're giving us that diversification, which is
Yeah.
that airbag you were talking about as to why we
Yeah.
want to have those bonds in the portfolio. On the con side, yeah, inflation has continued to sort of plateau, or it's not
Yeah.
falling as fast anymore. It's kind of stagnated around that 3% level. Ongoing policy uncertainty. We seem to be saying that about all of the asset classes right now, certainly a big issue. And then we mentioned the Fed chair. Does the Fed chair come in and want to cut rates
Yeah.
too fast to please the president, which could be a negative for bonds because inflation stays higher? So for us, we're again bullish on bonds. We think they're doing what they're in the portfolio to do, give you some income for those clients who need
Yep.
income on a regular basis, and give us that smoothing effect to smooth the ups and the downs of the stock market when things are happening there. So we want to
Yeah.
watch it. We're going to keep our bonds pretty short, meaning we want maturities over the next 2 or 3 years. We don't want to be lending money out for the next 10 years just because the concern about inflation is there and we're
Yeah.
not getting
Added
paid a lot
risk.
of. Yeah.
Yeah. Essentially looking at our risk and trying to reduce it. And so these are yields. Can you talk to me a little bit about what is a bond yield? Why is it important? And then also what that looks like going forward.
Sure. So again, you'll notice this 10-year treasury yield keeps coming up that we've been talking about even
Yeah.
from earlier in the slides. You see it's at 417. After the Greenland news yesterday, it's actually moved up to about 4.3 as of this morning. But yield is what, if you buy a 10-year treasury bond today and you simply held it for 10 years, you would earn 4.17% compounded annually over that 10-year period. That's the yield. Some of that'll come from the coupon. If the bond's trading maybe a little bit cheap, you might get a little bit
Hmm.
of capital gain as it goes to most bonds have a maturity value of $1,000. And
Yep.
so if you buy it for a little less, maybe you'll get a little gain, but the total return you'll earn will be just over
Yeah.
4%.
So in a just like stripped down version, yield is kind of like your overall return from the many different places for holding a bond, similar to your return with the stock,
Exactly.
but using a different word and different pieces that make up your return.
Yeah, but just think of it as return. And what's useful or what I think is interesting about this chart is with the rates at this level where they're now higher at
Hmm.
4.2%, even if rates go up a little bit, you see, even up to 4.5%, we still get a positive 2% return from that particular bond. So we have additional cushion in there now with those higher rates, and that's the key part to see. And if
Yep.
rates go down, obviously you earn a little bit higher return than that 4.2%. As you see, if rates were to drop to 3.5, for example, you'd see you get an 8% return on that same investment.
Which is pretty impressive to get an 8% return from a bond, right?
Well, and as you highlighted earlier, we saw 7% from bonds last year, so
Yeah.
it's a really, really
Yeah.
good year for us.
Yeah. No, exactly. All right. So tell me a little bit about spreads. And just so you know, all of you, we're coming up to the end. I know that this is very detailed, but we really wanted to use these terms to explain it because when you're reading something or learning about bonds, you're going to see these words. So tell me, what is a spread? What is a spread?
So you can think of a spread as just sort of a risk premium. And so we mentioned
Okay.
before that a 10-year treasury bond is considered a risk-free investment.
Yep.
And with a spread, if you lend to Procter and Gamble, they're more risky than the US government because they
Hmm.
can't print money for no other reason than that. They also can't tax us to pay off their debt. And so normally when you lend money to somebody who's riskier, you get a premium, you get extra. That's what the spread is. So I might be willing to lend money to Procter and Gamble if you pay me 1% more than a treasury bond, because Procter and Gamble is a pretty stable company. But if we
Yeah.
had a small upstart company, I might say I want 5% more or
Yeah.
7% more, or
To
I'm not
compensate
lending you
you.
any money. And what you can see here, and the concern that we have is if you look at these spreads, and I'll use USIG corporate there, that's investment grade. So that would be like a Procter and Gamble. You can see that you're getting 0.77% more. That's the spread. That's that risk premium you're getting. But the problem with that is historically it's been about 1.2% more. And so you're not getting paid for that, which means people are a little too optimistic in my mind about bonds, which is part of why we want to be invested in really high quality and keep it short as well, because we're just not getting paid to take a lot of risk at this point. If you look, Probably the best example of that is USHY, which stands for high yield. Those are really risky companies.
They are high yield. It sounds great, but they're also known as junk bonds. So that
Yes,
kind of puts it in context, right? Not that they're junk, but there's a lot of risk,
a
correct?
lot of risk. And you can see we're only getting about 2.5% extra right now for lending to those really risky companies,
Yeah,
where historically we've got 4. And if you
almost
go
a
back,
4%.
yeah,
Yeah.
if you go back
So
to times of stress, we've seen 10, 11, 12% extra return.
that's really smart. And I'm really glad that we showed this slide because, we have to be smart investors to make sure that we're being paid appropriately for the additional risk that we're taking. And, all of you listening that are Francis Financial clients, you don't have to worry about this stuff. But it is something that we look very, very closely at of what are we making? What is the risk? And are we being compensated appropriately for that risk? And you know, any investment can look good with rose-colored glasses, but you need to take off the rose-colored glasses and see, does this really make sense? And so, as Matt said, what we're doing is we're really looking at the uh, less risky bond assets for our clients so that we make sure that we're being properly compensated for the risk that we are taking in bonds, even though, for most bonds, it's a whole lot less than stocks in general. So, all right, so let's talk a little bit about what others are saying. This is, pretty much the second to the last slide, and then we'll do a nice, beautiful summary. Um, and so we have Goldman Sachs, talking, we have Angel Oak Capital, we have T. Rowe Price, we have John Hancock, as well as a few. Is there a trend among all of these, or are you seeing, you know, essentially what others are saying and all, very, very disparate, very different thoughts about this next year?
Yeah, I think that's right. Is we're seeing a little bit of everything. Nobody's so much uncertainty. There's always uncertainty. I think current times are maybe a little heightened uncertainty given the current administration. But you can see Goldman very positive on U.S. stocks. They're saying a 12% number next year. John Hancock there at the bottom, neutral on U.S. stocks. Goldman's positive, much like we are on international stocks with 11% returns forecast. Angel Oak was talking a little bit about bonds. They think it is a good environment for bonds. They think
Mhm,
active management, what you were just talking about, Stacy, figuring out where we're getting paid to take risk, where we're getting
mhm,
the
mhm.
proper reward is really important. And then T. Rowe Price kind of highlights a little bit about some of the infrastructure, some of the opportunities that come from investments that need to be made and will probably be made, with the ability to expense relative to the big, beautiful bill that's,
Yeah,
obviously fully implemented here as we move into 26 as well. So two key takeaways, they do sort of highlight a lot of what we just talked about and share, some of our opinions, but also, as you said, nobody has that crystal ball. So you see
yeah.
some big
And
differences
and the
there.
other thing I have to say is anyone that says they have a crystal ball, run the other way.
Yes, as
Run the
fast as
other
you
way.
can.
Yeah, so as a kind of a recap, bringing it all together, fundamentals really strong. A lot of consensus about 2026 being a good year. That definitely uncertainty regarding policy, adding risk. And so, number one thing, diversification, making sure that you are properly diversified across all the asset classes. And also, talk to me about this. Rebalancing reduces risks. I see that some people, their stocks, their U.S. stocks and their international stocks have grown very much in 2026, maybe even more, so much so that they're kind of out of balance and need to sell some of those best performing assets, and rebalance so that they are back to that, let's say, 60% stocks, 40% bonds. But the number one reason people don't want to do it is they're afraid to pay taxes. So talk to me about that and why it's so important to keep that ideal balance in your portfolio.
Yeah, that is. None of us like paying taxes. That's for sure. And so it can be very painful to write the bill. But yeah, great example if you think back to the chart we showed on performance. Large cap growth stocks, so big growth companies in the US, they've compounded at 15% a year for the last 5 years.
Yeah.
And so you are certainly overweighted in most portfolios if you haven't been rebalancing relative to those big growthy companies, those AI companies you're talking about that are really expensive. And if we saw a correction there, they can move really, really fast in the other
Yeah.
direction. And so that's where the rebalancing is so important. If we can shift that to long-term capital gains, and given the way we invest, pretty much any gain we would ever take for a client would be long-term, that's probably the most favorable tax rate that any of our clients are going to pay anyway. And what we can do is by locking in those gains and investing where we see some opportunities in some small companies, some value companies like we talked about, we reduce the risk of the portfolio and also give more growth opportunity there as well as we go forward.
Yeah. No, I love selling high and buying low. That is, a key element that I live my life by. And the other one that I love, and you say this all the time, a successful investor, it's about time in the market, not market timing. And I love this chart really to talk about market corrections or pullbacks that typically we see 5% pullbacks each year. We'll see at least one 10% correction or pullback in a year, and we'll see a 15% pullback every 3 years, and we'll see one, at least one, and for many, last couple of years it's been more, a 20% pullback every 5 years. And it's normal. It's normal, it's healthy, and it's nothing to worry about. And if you kept your money in the market, as we saw, a diversified portfolio earning about 9% each year over the last 5 years, and in this situation, we're looking at the, S&P 500. The return historically going back decades is 11% annual return. Like that's impressive. And we run our plans to be conservative just at a 5% return. So, if you're investing in a diversified portfolio, you're besting that by, almost 3%. And that means that you can spend more money in retirement, maybe take a little bit more vacation. It could be that you end up retiring a little early, right? These are all really important things. And again, it's about the time in the market. It's not trying to time the market. Market timers over and over, we see that they actually underperform. They underperform long term. And so you do not want to be one of those. Definitely not.
Uh, that's great advice to leave everyone on, Stacy.
I know. And I just have to say thank you so much. It was great to have you here, Matt. I could talk to you all day. And for all of you listening, if you have any questions about your portfolio, if you're a Francis Financial client or you're not, and you just would like maybe a second opinion about, how am I invested? What risk do I have? Do you have any suggestions that you might make? Feel free to email me, Stacy, Stacy, at francisfinancial.com. And I also encourage you to visit our website. We have some great information on there at www.francisfinancial.com. Happy to chat with you. I know for me, my favorite job is talking to people and kind of hearing what their concerns are, and most importantly, being able to give them the answers to make sure that they're on the right path. And Matt is an absolute genius in this area of investing and has a superpower of being able to make all this very complex, sometimes very technical information interesting and understandable for individuals. And I think that's really so powerful. So thank you so, Matt. And again, all of you who are interested in Francis Financial, please do reach out to us. You can go to our website again, www.francisfinancial.com, or you can email me, Stacy, Stacy, at Francis Financial. Matt, thanks for being here. We really appreciate you.
Well, thank you, Stacy. It was a lot of fun.
Great. Talk to you soon.